Well, happy Friday, y'all. We have got some good news to report with regard to interest rates. So we're going to dive right in and look at the numbers. I waited until today. Whenever we have big news that comes out on a Friday, y'all, I'm going to push the video from Thursday to Friday unless we have something that happens midweek that prompts a video. But I wanted to get the PCE results this morning, personal consumption expenditures, the Fed's favorite gauge of inflation. We got it exactly in line with expectation, y'all, both on the headline number and on the core read. So we were at 2.5, down from 2.6 year over year in the headline number, exactly meeting expectations for this report. The core, stripping out food and energy, was down to 2.6 from 2.9, again, as expected, y'all. This is exactly where we thought this report would be, and no surprises helped the bond market. Y'all, the bond market is very much a pessimistic trading vehicle. Fixed incomes are where people go when they don't want to worry about their money. So when we get no surprises, there's always a bit of a relief, and you see that reflected in today's pricing. Particularly in light, y'all, one of the things that's benefiting the bond market significantly is the fact that the Dow and stocks in general have had a really rocky period over the last 30 days or so since the election. They're trying to get a handle on how to trade stocks and how to value companies with all of the changes that we're going to see administratively and legislatively. Talking about tariffs, talking about tax cuts, talking about whether spending cuts are going to be real, requiring less debt issuance over time. All of those things create a very complex picture, and equities are struggling to find a footing around how to price to these new realities as they start manifesting themselves. That has led to the Dow being down 1,400 points over the last 30 days. So it's been a rough February for the Dow Jones in particular. So the NASDAQ is also getting hammered. You have some massive moves in stocks like NVIDIA. You know, even though NVIDIA exceeded expectations for their profit report yesterday, the market is still struggling to find a way for that company to be worth a $3 trillion market cap. So there's a lot of outsized and resizing being done on the equity side. All of that is creating a little bit of inflow into the bond market, and that's helping interest rates as well. Here's where we are. Mortgage News Daily, 30-year fixed rate conforming loan, today 6.74%. Folks, you got to go back to December 9th of last year to find rates as low as they are today. So we are sitting at multi-month lows in interest rates. 1 week ago, we were at 6.89. 30 days ago, we were at 7.07. So y'all, we're about a third of a point better in rate than we were this time 30 days ago, and that is a nice reprieve going into spring, especially starting to get into the buying season as listing inventory starts picking up, being able to offer rates in the low to mid sixes to borrowers, because keep in mind that 674 is a national average. We're significantly lower locally, so call me and we'll talk about that for your specific deals. Here's what it means for a typical mortgage, y'all. A $400,000 mortgage 30 days ago at 7.07% would have cost you $2,680 a month for your principal and interest payment. That same $400,000 mortgage today is $2,591 a month at 6.74. So that's about a $90 difference in payment. Y'all, if you do the math backwards from that, you can buy $13,500 more house today than you could 30 days ago for the same monthly payment. That's a significant increase in affordability, y'all. So when people ask what difference does it make that rates have moved a quarter to 3/8 in rate, well, significant, y'all. $14,000, $15,000 in buying power every time we see a move of that size. So it's significant. What does that mean as far as the predictions for what the Fed might do? Well, it's been interesting. The CME FedWatch tool now has a 75% chance of a quarter point cut on or before the June 18th meeting of the Fed. Y'all, when we did a call last week, we were looking at a September expectation for that cut to occur. We've now moved that up into June. So the market is now fully expecting that we will see cuts on or before the June 18th meeting. And if you look at how Fed futures are trading through the end of the year, there's now a 52% chance of the Fed moving a half or more before the end of the year in total cuts. That's an increase from where we had been just a few weeks ago when we were pretty much set on the notion that the Fed would not go more than a quarter additional for the remainder of the year. Now seeing a stronger likelihood of the Fed moving a half or more by the end of the year. What does all that mean? It's good news, y'all. It's good news on the housing front, at least. The instability is not a lot of fun for folks that make a living off of equities. But as far as interest rates are concerned, everything that we're seeing right now is more green than red, and that's encouraging. As always, we provide this information so that you can equip your borrowers with the best possible information as folks are considering moves in the marketplace. We are here to make those the most informed moves possible. If you'd like to use our services for a mortgage, it's why we do these calls. We're honored to have your referrals. All my contact info is on the screen. Stay blessed, stay safe. Looks like a beautiful weekend. Hope y'all enjoy. Talk to you soon.